Never ever buy one of these in your personal name. Always buy property houses in a limited company because it stops you getting absolutely clobbered for tax. So for example, if I bought this in my personal name, I put a tenant in it and the tenant was giving me £2,000 a month, I'm taxed on the full £2,000 a month because of Section 24. However, if I set up a limited company and bought it in the limited company, I could offset my mortgage interest, I could offset other costs, and I'm only taxed on the profit. So it's much more tax efficient. The other benefit of buying in a limited company is it's not about you. So you're not capped on how much you can borrow. You can borrow a lot more money because they look at the asset and what the asset's going to do, not you. So anybody today could go and set up a brand new limited company that's for assets and get 75% lending to buy property, to be a property investor. So never, ever, ever buy these in your personal name.
Some of that's correct. I think you can still deduct expenses if you're a private landlord owning the property in your name. So things like insurance and agents' fees, those are still deductible. So I'm not sure where she got that from. And if you do have mortgage interest, then a part of that is tax deductible, but it comes through as a tax credit further down the line rather than it being a straight deduction. And of course, if you're a 20% taxpayer, it makes no difference. If you're a 40% taxpayer or upwards, then it will. And of course, if you're able to make a property investment as a sideline, you may well be more likely to be a 40% taxpayer. Lending to a company will typically ensure a higher interest rate than if you're taking a personal mortgage. So it's not as simple as always being cheaper. And you've got the costs of setting up the company. You've got the costs of operating the company every year, filing accounts, corporate tax returns, etc. So it's not as simple that it's always better.